Millions of homeowners are at risk of selling their property at a loss, and in this video, I want to go over exactly how you can prevent this from happening to you, how you can analyze homes so that you don't get into these situations, and ultimately, I want to spread this information across so that you can best protect yourselves when going into a property. And as you can see here in this article, this was published on July 7th of 2025. And we're recording this in September, so it was about a month or two ago, so not too far back. But what's showing is that post-pandemic home buyers are at the greatest risk of losing money in a sale. And nearly 6%, or roughly 1 out of every 17 of US home sellers, are at risk of taking a loss if they sell today. And that's a 36% jump from this time last year, according to a report here in Redfin. And I share this with you because I know a lot of people want to purchase their dream home, and many people make emotional decisions, which I completely understand because buying a home is an emotional journey, and as it should be. And especially if that's going to be your forever home, it's something that's going to be very dear and close to your heart. But I want to make sure that regardless of whether it is a home that you're planning to stay in forever, or maybe it's a home that you're temporarily going to stay in. Maybe it's a starter home that you're going to upgrade to later on. Whatever it might be, I want to make sure that you understand what the implications are when you do purchase a property, how you can analyze it so you can run the simulations on what risks you're going to inherit if you do make an offer and buy this home. And I think it's very important for everyone to understand this. So without further ado, let's just dive right into it. Hey, my name is Hayato. I manage and own a real estate fund, and I have absolutely nothing to sell you. And like I mentioned in the beginning of this video, I'm going to go over and show exactly how you can go into home ownership more calculated to run numbers like an investor, even if it's your forever home, so that this gives you a backup plan if things don't go the way you initially planned it to. So that's the purpose of why I'm making this. And here are some of the reasons why people get hurt when they purchase homes. Number one, they purchase based on emotions instead of math. And they assume that their income will never change. Maybe you got a big bonus and maybe you got a great job and you feel like you're going to get that, you're going to keep that income forever. But sometimes that's not true. Reality kicks in and maybe you lose your job, maybe you get laid off. And in those instances, you can get hurt. And number three, you don't run sensitivity tests for things like interest rates or property tax hikes and changes. And when life changes, whether it's a job loss, a relocation, or unexpected repairs, the home becomes a money pit instead of an asset. And here are 3 simple rules that I want to share with you. I could share so many different things, but these 3 simple rules should at least help you look at home ownership a little bit differently and help you analyze homes a little bit more in depth so that when you do find the right one for you, then you can go into it knowing, again, what the implications are. So let's dive in. Rule number 1, always ask, can I rent this out if I had to? Let's run an example here. Let's say that you found a home for $400,000 and it is an amazing home. It's the dream home that you've always wanted. Let's say you saved up 10% of that home price as a down payment. So you saved up $40,000. Now, what that means is you're going to take a loan for $360,000. And let's say at today's interest rates at just around 6.5% or so, again, this could change. And this is where the sensitivity analysis comes in. You want to play the numbers out to see, hey, if it goes up to 7%, 7.5%, can I still make the monthly payments? And don't run the best case scenarios, right? When investors run numbers, they don't always run best case scenarios. They run both the best case, the middle, most realistic case, and then the worst case scenarios. You want to run those scenarios for yourself too when buying a home, and want to make sure that you have the capacity to navigate whichever way things go. So with 6.5% being the interest rate, that would be just around $2,300 per month just with principal and interest. Then you might have property taxes. Well, not you might, you will have property taxes at $500 per month, and that can vary by state. And you can assume, let's say, 1.5% of the property price annually. And then you also have insurance at $150 per month. And these two have generally gone up year over year. It doesn't get cheaper. And so you want to make sure that you account for the increases in property taxes that happen when reassessment comes around and insurance going up. And you also want to account for maintenance and reserves because home ownership comes with maintenance. You're going to have to make repairs on the home, whether it's plumbing issues, whether it's HVAC, whether it's roof, whether it's your hot water tank. Whatever it is, you're going to have money set aside for maintenance. And most homeowners who want to live in their forever home or dream home don't consider this and don't think about it at all when purchasing. So it's absolutely crucial that you set aside some funds for this. And the thing is, every investor does this, but no one shows and no one teaches homeowners to do this. So that's why it's really important that I share this alongside with you. So that means your monthly cost is $3,125. So if you had to move out, you'd need to rent this property to cover at least $3,125 per month just to break even. And if you're seeing that the market rents in your area are $2,600, maybe $2,500 in your area, you're already going to lose $500 per month before factoring vacancies. And this is really important when you are making your decision on how you purchase your property, because if you barely have enough to cover this on your income alone, and let's say you do get laid off and you don't have emergency funds and you aren't able to find a job that easily that pays the same amount, and maybe you do get paid less in your next job, and who knows how long that will take, that means even if you were able to rent it out for $2,600 in this scenario, you need to be okay with losing $500 per month on this property. And worst case, if you continue living in it, you need to be okay with losing $3,125 on the property every single month, right? And so, and unless you have well over the amount, maybe 4, 5, 6 times the amount of money that you need in order to cover your monthly mortgage payments, then you should seriously consider purchasing in areas where the market rents can at least cover your entire monthly expenses, including, again, not just your mortgage payments, your principal interest, but your taxes, insurance, and maintenance reserves. That's extremely important. Rule number 2, test your sensitivity. So what happens if rates or taxes go up? You need to underwrite for it. So let's say mortgage rates rise to 7.5% before you close. Your monthly payment now has jumped up by $250 plus. Maybe you go with a variable rate and not a fixed rate. That means maybe 3 years, 5 years down the line, your 6.5% could change very well to whatever the market rate is at that moment. And so you want to make sure that you know exactly what your payments could look like and how much it could go. And if the county reassesses your property, and it's not if, it's actually when the county reassesses your property, your taxes could rise 20%, and that's another $100 per month. Suddenly your break even rent isn't $3,125 anymore. It's $3,500 plus. This is a clear and simple picture that I want to paint for everyone. And people who don't run these numbers feel crushed when these rates or taxes change because they don't know what could happen to them. Make sure you test your sensitivity and make sure that you're able to withstand these sensitivities. Finally, rule number 3, don't buy at the edge of your budget. I see many people do this. Many people fall in love emotionally with the homes that they're looking to buy. And I get it. You walk into it, you find beautiful kitchen cabinets and beautiful islands that you've always wanted. Maybe the basement looks amazing. Maybe the backyard has additional things that maybe no other properties have. Whatever it might be, do not buy at the edge of your budget. Banks may approve you for a $400K loan, but that doesn't mean you can actually afford it. Because if that property cannot even come close to covering itself as a rental, you're betting everything on your income stability. Life is rarely that stable. Things happen. And so even if you make $20,000 a month, if you go and buy $1.5 million home and you're spending $10,000 to $15,000 per month just on your monthly mortgage and expenses, then you're really not leaving that much room for yourself. The rule of thumb is you want your expenses to be just shy of 30% of what your after post-tax income is. Ideally, you stay within that range. And if you can, maybe 30% of your pre-tax income. But that should be the absolute max that you're really looking to buy a home. Otherwise, you're going to put yourself in a situation where it can get uncomfortable. Or if you can't do this for whatever reason, then at least keep the gap between your costs and market rent small enough that you could float it during a transition if you needed to. These are the 3 simple rules that I think will help prevent a lot of people from going into financial struggles and will help them understand what they're going into before they actually make a big purchase decision. So here's my final take. Even if you plan to live there forever, you should run your numbers like an investor. Because here's the truth. Those who don't run numbers are the ones who get hurt. So your home can be both a place to live and a safety net, but only if you evaluate it with clear eyes. And if you like this type of content, please don't forget to leave a like, comment, and subscribe, and I'll see you on the next video. If you have any questions, leave them in the comments below. Bye.